What do you think stops people from getting financial advice?
The advisor genuinely becomes that trusted advisor, but in a much rounder sense than just the money.
Do they put unnecessary barriers to good advisors running their businesses and penalize good advisors for the bad advisors? Oh, totally.
Hello everyone, welcome back to another episode of The Way of Wealth with myself, Pajesh, and my co-host, Mohammed. He's been away for a little while. He's been very busy on client meetings, as you can tell by his dashing attire. Usually it's myself wearing the three-piece suits and Mo wearing the jeans and the trainers. So this feels a little bit unusual. But anyway, we've got a brand new guest for you guys. Mike Middleton, welcome.
Thank you.
As an introduction to Mike, he is a retired financial advisor with over 35 years experience. He's managed over £100 million in wealth, and he's sold 2 financial planning businesses. He's published 2 books, and he's co-authored a Wall Street Journal bestseller. And he's currently writing his 3rd book. It's a very impressive CV, Mike.
Thank you.
Have I missed anything there?
No.
Okay.
Hopefully.
Tell me more about the current book you're writing.
Oh, crikey. So that its working title is Smart Money. So it expands really on the 2 previous books, which are predominantly aimed at people planning retirement. And fundamentally, my belief about financial planning is it's really about planning your life first and then designing your money to fit your life.
Yeah.
The financial services industry has a habit of reversing that process. So it's more interested in accumulating wealth and then wondering what to do with it.
Mm.
When actually you get a much more successful investment outcome and financial outcome if you plan your life first and then design your finances to fit whatever that life is about. So Smart Money really is a kind of self-help guide to what does that look like, how do you go about it, the steps and the processes involved.
Mm-hmm.
So
What was your motivation, Mike, in writing the 3 books?
I guess to try to get 2 things out. One is information to those who genuinely can't afford to come and take the advice and help of guys like you or me in the past, but also to help educate the wealthier people into why actually they might need to take some advice. I mean, I was at a meeting 3 weeks ago. A long-established accountancy firm in the Midlands and set up by former partners of one of the big 6 accounting practices in the UK. They have SME clients only.
Okay.
They're very specific about the type of business that those clients would have.
Yeah.
And they believe over 90% of their clients do not take financial advice.
Yeah.
Won't work with a financial advisor.
I'm not surprised.
And some of that's down to them being sort of control freaks.
Yeah.
Because oftentimes, entrepreneurs are a bit control freakery.
Mm-hmm.
Ignorance.
Yeah.
And just that kind of peculiar belief that, I don't need all that. My business is my pension or some words to that effect that people will often come out with. So that it's weird. You would think that folk with actually piles of money, and we are talking about this particular practice, their clients are all multi-millionaires who get no help with their money.
Yeah.
And I think smart.
Yeah.
Generally, so that's another. I think that the same message can be addressed to both audiences.
What do you think, stops people from getting financial advice?
Hmm.
Or even private client advice, some expert advice?
I'm not entirely sure. There's
Mm.
probably a number of reasons.
Mm.
I think when it comes to very successful people, and that doesn't matter whether they're working in the city or running their own businesses, there's a time issue.
Yep.
And I'll deal with it tomorrow.
Yep.
And that's definitely one thing. There's the issue of trust.
Yeah.
Cost, or what they perceive to be the cost.
Yeah.
Of advice, and that's often gross. It's really exaggerated through the media, and if I'm allowed to say this, I don't think the regulator helps.
Yeah.
When actually sometimes if you take the cost of good advice and relate it to the outcome that people can achieve, it's often as cheap as chips. But there's just there's a barrage of information in the financial pages of the daily papers. Did you know you're losing out by X if you use a financial advisor? Your pension would be, Y better if you didn't do it, and all that sort of thing.
Yeah.
So I think that's a problem. And the other thing is, it's almost a little bit like a lawyer. They're almost this sense that you don't need to do something until there is an event that requires you to think, oh my Lord, I need some help. So that, the younger people, that could be sort of saving for their first home, getting a mortgage, taking out some life insurance. And for older people, it's like you're forced into a position of saying, I need to do something with my pension, retirement things, because I'm due to retire.
Yeah.
So there's a point at which they're being obliged to take action. I mean, in the late 1980s, I was at a conference, and I have never seen, I've not known this change. There was a speaker on the stage said that there's four ages of humankind when it comes to retirement planning, for example.
Yep.
In your 20s, complete ambivalence.
Yep.
In your 30s, mild awareness.
Yeah.
Your 40s, keen interest.
Yeah.
And in your 50s, sheer panic.
Yeah.
And so it's that panic point, whether it's the mortgage or the retirement or the death of a spouse or an illness or a tax bill you weren't expecting, that causes folk to say, oh my word, I need to do something about it. Otherwise, it almost doesn't seem to cross people's mind. But bizarrely, once someone has bought into everything, the need for advice and help, my experience certainly, has been that those people then want, demand, welcome the ongoing input of their advisor. So the advisor genuinely becomes that trusted advisor, but in a much rounder sense than just the money.
Do you know what it is also? And I'm increasingly thinking this, because I'm also often thinking about this advice gap that we often hear in the industry quite a lot. And then there's a huge group of people who really need advice, but it's just not cost effective for professional advisors to actually service them, which is a huge shame, because it's that particular group that needs advice in relation to building wealth and preserving wealth as well, as much as possible. I mean, advising somebody simply to take out a life policy. I mean, this is the most rudimentary aspect of financial planning. But that one single act of taking out a life policy could have a dramatic impact on that particular family later on in life. However, what I've been thinking about is post or pre RDR, all right, when we had an environment where advisors could take commission from putting in place investment policies, okay, and certain other type of products. Could that have been actually a way to bridge the advice gap? Or did we even have an advice gap back then? Because I do appreciate advisors then were more about, selling a particular product. Okay. And they weren't nowhere near as qualified as they are today. But if they were able to receive some type of commission payment, it could actually make it cost effective to actually service that huge group of people who are not receiving advice right now. So I'd be keen to hear your thoughts on, especially 35 years in the industry, how the industry has evolved in that regard. And I'm not pro or nor am I anti in terms of commission-based sales, by the way.
I mean, in there you inferred that there's an issue, or maybe a non-issue, with the so-called advice gap. And I'm not going to be able to recall the data now, but I was in 4 or 5 months ago. I did some research about how many life insurance policies had been sold in 1990 versus as a proportion of the population and the number of people taking advice today, according to the FCA. And the numbers proportionally were about the same.
Okay, interesting.
So I thought it was interesting because I was expecting, given the narrative around the financial advice gap, that more people were getting some sort of financial help back then than they are now. But that very, very simple bit of research, I wouldn't like to stake my life on the output, but suggested otherwise. But I understand why the commission situation was an issue and why if we go right back to the 80s, the Financial Services Act was trying to address the way in which the industry was behaving. Or misbehaving, as was often the case. But if we take the clock even further back, go back 100 years or more, insurance companies like the Prudential, Pearl Assurance, Britannic, I mean, there's a huge array of home service insurance companies. It still existed when I started out, going door to door. They would sell a simple insurance. It might be as simple as a penny policy, whole of life policy, with the aim that there was enough money to bury somebody in the family come the inevitable. And usually those life insurance sales were carried out around the kitchen table. And it would be the matriarch of the family that actually usually drove her husband to saying yes and signing up. And every week the man from the Pru would knock on the door, collect the premium, mark it in his book, and off he would go. At shoe level was really expensive. The investment returns that were feasible for a lot of that time through with profits policy type things were easier to achieve because interest rates tended to be higher. They didn't have to take quite so much risk. Longevity wasn't quite so the actuaries could kind of work out returns for their policy holders that worked in favor of the survivor. So there was a kind of longevity. The output for survivors was great. And clearly things started to change through post-regulation. Interest rates started to come down. The cost of running those sorts of businesses started to collapse. The direct sales forces of the Prudential and the Pearl and all of these others started to fall in number, and by 2000 they pretty much gone.
Yeah.
The other big change, of course, is that people are increasingly wealthy, so that the average working family in the UK 100 years ago was struggling to put bread on the table. Today they can go on a holiday to Turkey or Spain or Egypt or wherever it is that they fancy, as well as doing all sorts of other stuff.
But I would argue that is largely probably driven by lifestyle creep. So they could be putting money onto credit cards and taking personal loans out because we've got personal debt higher than ever before.
I think that's true. Yeah.
And
sure.
But you make very good points in relation to the protection. Protection, you get commission anyway. But I'm talking about putting in place pension plans, ISA plans, and potentially. And I'm not saying I'm an advocate of this, all right? But if there was a commission payment to advisors to allow them to service clients who need these type of arrangements, could that bridge the advice gap effectively? But having said that, what is more important as a result of the entire advice process is to have a conversation around budgeting, emergency cash provision, which I'll probably, maybe that wasn't ever done in the same way as it is done today. Because right now there is a huge emphasis on treating customers fairly, good client outcomes. So you effectively, the profession, which is a profession that I'm incredibly proud about now. I think, yes, we have an industry that has a love-hate relationship with the regulator, but I'm actually more comfortable that the regulator is actually there from a consumer protection point of view. Do they put unnecessary barriers to good advisors running their businesses and penalize good advisors for the bad advisors? Totally. But I think that needs to be resolved at a statutory level, not just at a regulatory level. In terms of the role of the director, penalizing directors, more action against directors who are clearly guilty of misconduct, and then phoenixing into another business quite easily. Those type of issues I think are very, very important to be addressed.
I would agree, and I mean one of the things that was absolutely true. I mean, so I was in my late 20s when I joined what was then a general insurance broking business, and the financial products were so opaque. I mean, I didn't have a clue. It's embarrassing to admit this, but it's a fact. I didn't have a clue what we were selling.
No, that's not good, Mike.
And not in anybody else.
So all those millions that you built up.
Yeah, well, actually, but throughout the 90s, I mean, most of what I was doing was selling life insurance and savings plans and small pension contributions.
But I don't like the way you were selling, because I know you're a fantastic advisor though.
But that I evolved.
All right, all right, that's interesting. All right, so so you were terrible in the beginning, but I don't know, you had a butterfly effect or something. All right.
People have often asked me about. I mean, because the financial services industry was constructed on. You were deemed successful by the volume of sales.
Oh yeah, of course, yeah.
On that basis, I was terrible.
Okay.
Because I just didn't, loads of people who just flog all sorts of anything to anyone and really didn't care about client outcomes. I was lucky that I worked with a guy who sadly passed away a few years ago, who I wish he was here because I'd ask him, because I don't, but I'm pretty confident I know the answer, is that he didn't realise that he created a very simple form of lifetime cash flow model.
Okay.
And there was no software around that we could use in there. We were using scientific calculators, Lotus 123, insurance company projections,
Brilliant.
and putting it all together on and typing it up in a simple document.
Yeah.
And the idea of it, and the way John came up with it, was to try and make sure he could sell the idea that people would need to make a saving towards their long-term future.
Oh, great.
So I got cash flow modeling religion from a chap called Paul Etheridge, who also sadly no longer with us. Created a piece of software called Presswood, going way back, and Paul founded the Institute of Financial Services. The Institute of Financial Planning, I beg your pardon. And it was thanks to him that I suddenly thought, oh, hold on a minute, this is a way more intelligent approach to dealing with your clients' affairs.
Yeah.
And I mean, you're right that today people are far better qualified to do what they do, and that's right, I believe. I mean, when I sold my product, I got 3 really bright people working with me.
Yeah.
All of whom had been to university.
Yeah.
And all of whom had begun their careers in financial services before they. So one had worked for an IFA, the other 2 had worked at different banks. I mean, 2 of them had law degrees.
Yeah.
One had a business degree from, all from decent universities.
Yeah.
Way brighter than me.
Yeah.
All very well qualified. When I came into financial services, it was a kind of an act of desperation, because I saw people that I'd been to school with driving nicer cars than me, wearing suits, and I thought, well, I've got to get a job in a suit. Where do I do that?
Yeah.
Because I didn't have any qualifications. It was subsequent to that I discovered I wasn't a complete idiot, and so I'm not quite sure why I'm
that's really useful.
blathering on about all of that. So I think it's right that we've got regulation. The incentives that were around were completely misaligned.
Yeah.
And it was the late Charlie Munger, wasn't it, who said, show me the incentive and I'll show you the outcome.
Yeah.
Or words to that effect. And incentive can mislead, misdirect a market. Credit crisis is a fantastic example of what can go badly wrong if you construct financial products with an incentive that misaligns itself from the good of the mortgage holder and society as a whole.
Join us for part 2, which will be our next upload coming very soon.